So in order to pay for college and get a full college funding refund in retirement, you need these three non-negotiable components. You need uninterrupted compounding interest on your money. Then you're going to use your money as collateral to secure a loan at a lower interest rate. And then you're going to have optional loan payments so that your loans will compound interest, but the compounding interest will also compound at a greater rate, creating that positive spread. Now, there's also a lot of nice to have features like I mentioned earlier. You obviously want a good rate of return on your money. You don't want it to negatively affect your EFC number so you can maximize that free money. You want low fees. You want tax-deferred growth on your money. You want to be able to access the money tax-free. In a perfect world, you'd like to be able to deduct the money going into the plan as well. We don't want any stock market losses, especially for college funding, because we're dealing with a shorter time frame. We don't want to have to make up for a loss in the market. Okay, we want guaranteed loan approval. What if you have young kids? We want to be able to guarantee that in the future we can implement this strategy. We want fixed loan rates. We don't want any variable rates. We want high contribution limits, flexible contributions in case you had a financial setback. We want access to the money. This, in addition to the three non-negotiable components, is how this strategy can work. So you're driving down the freeway and you see a billboard for your state 529 plan. Plus, everyone uses a 529 plan and your financial advisor says it's the best thing to do. So clearly, it must be the best way to save and pay for college, right? Well, let's check. Here's your 529 account. Here are the features. Can you use your 529 money as collateral and borrow against it and allow it to keep compounding interest and have an optional loan payment on those loans? No. Does it have some of these features? Yes, but it doesn't have the three non-negotiable features. How about the banks? Absolutely not, because that's what the banks do. The banks are the ones giving you less than 1% on your savings and charging you 4 or 5% or more on your loans. How about a 401k plan? Well, a 401k plan is a little bit unique because although you don't have access to it until you're 59 and a half without a penalty, you can take a loan against a 401k, but it is interrupting the compounding interest. Your employer isn't going to give you the money. They're simply allowing you to have early access to your money without a penalty. So you don't have any of those non-negotiable components, but you do have a few other features, especially on the loans. Now, what about the stock market like Jeff Bezos and Elon Musk? Can you use your stock portfolio as collateral and borrow against it? Yes, it's called a margin loan. You could call up Charles Schwab and say, hey, I want to use my stocks as collateral to borrow money. The only problem is that they're going to want a payment on that margin loan. And if your stocks ever crash, you're going to lose the collateral and they're going to want a payment to pay off those loans, which means you're going to have to sell your stocks at the low point, causing potentially even capital gains, and you're selling when the market's low. The billionaires and a lot of the wealthy people can do this a lot easier because they have so much money in stocks that if they borrow a little bit of money, it could work. But then you're still making a payment towards those loans, right? And wouldn't you rather put your money towards earning 7% instead of towards those loans? Wouldn't you rather have an optional loan payment? Plus, money in a stock portfolio does negatively affect your EFC number. Now, technically, if you're not selling the stocks, there's no capital gain. If you're borrowing against it, you could get to the money tax-free. Now, what about real estate? One of the things that I love about real estate is that if you take out a home equity loan or a line of credit, does it change the value of your house? No. The value of your house continues to appreciate, assuming that the markets go up, and you can simply borrow against it, allowing that asset, your house, to continue to appreciate. Now, because you're using your house as collateral, in most cases, you can get a pretty competitive rate on those loans. The only problem is, have you ever heard of a mortgage company or a bank that will give you a loan that doesn't require a loan payment? No, that's one of the biggest challenges with real estate. Now, in some cases, you could put an investment property inside of an LLC, and because it's a business, that could shelter it from the EFC calculations for some schools, but most schools are going to look at that as an asset. And a lot of schools are also going to look at the equity in your home as an asset as well. So sometimes you can shelter that from the EFC number and sometimes you can't. And of course, we all know what it's like to try to get a loan from a mortgage company and all the hoops that you have to jump through. That can be a complete nightmare. Okay, so what about cash value life insurance? There are specific types of life insurance plans that can actually earn a 6 to 8% average return, that you can borrow the money at 5% from the insurance company, and they give you an optional loan payment, allowing this strategy to work. Plus, you get a lot of these additional benefits as well. The challenge with life insurance, and the reason why in most cases it doesn't work, is because of the high fees. Let me explain how cash value life insurance works. Let's say that you're earning a 6% return on the savings portion of this life insurance plan. So let's say you're contributing $10,000 to this plan each year for 10 years. There are going to be these really high expenses because you're actually buying life insurance. And it's the life insurance that makes this so expensive. I mean, we're talking 35% of your money is going towards these expenses. Plus, the other problem is that they don't give you access to very much of your money, especially in the beginning. But it's really the fees that are the biggest problem, because look at these expenses as you get into your 80s and your 90s. The expenses are out of control because you're getting older and you're still paying for all of this insurance over here. Look at what that does to the interest that you're earning and your account balance. It causes it to completely disappear.